Evictions are coming as small businesses miss rent payments. I'm your host, Steven Van Metre, and thanks for joining me today. And despite claims by the Federal Reserve that the economy is booming, the one place it's not booming for is small businesses. And will this bond rout ever come to an end? Well, in today's show, we're going to look at what's driving rates higher and what perhaps may cause them to come crashing back down. Let's kick this story off where we head over to more retailers say they can't pay rent, even as shoppers keep shopping. Consumer spending is expected to rise this year, something we're going to challenge, but retailers aren't out of the woods yet. Many are struggling with rents, which have been rising with inflation. And 34% of small retail businesses couldn't make rent in April, which is a staggering number of 6 percentage points from February, citing a recent survey. Retailers pointing to inflation, gas prices, supply chain issues, labor shortage, and reduced revenues as compounding their financial woes. But retailers may not have to worry about shoppers backing off for long, in part because inflation is going to slack off somewhat later this year. The National Retail Federation predicts that retail sales for 2022 will rise between 6 and 8%, a rate that is ahead of inflation forecast this year. But are they? Well, one of the challenges, as we looked at on Friday's show, is that wages just aren't keeping up with inflation. And here you can see the average hourly earnings month over month in April fell from 0.5% to 0.3%. Average hourly earnings fell from 5.6% to 5.5%, all well below inflation, suggesting that consumers can't afford higher prices, and even if prices come down a little bit, won't make a difference. Despite the relatively high rate of inflation for the year and the potential for some slowdown in the economy, underlying strength and momentum from both the consumer and business sector are likely to offset a modest slowdown and should leave the economy bustling forward this year. But as you know, I don't think that's quite how it's going to work. Let's take a look at these charts that suggest that the economy is actually going to come way down, and so will retail sales. The first one we want to look at is advanced retail sales on a year-over-year rate of change. That's in blue against the Wilshire 5000, which is the total U.S. stock market in red. And notably, we can see that here in 2000s, going into the recession, that as the stock market came down, what happened to the year-over-year rate of change in retail sales? It slowed down, briefly went negative. How about going into the great financial crisis? See retail sales going down and contracting as the stock market went down. How about here 2018 through 2020, stock market stopped really growing. Notably, retail sales slowed, and even though they continued to grow, the rate of growth slowed considerably. And now we can see a stock market headed down and retail sales are nosediving. And what's also causing that is consumer sentiment. We see this in red against the same year-over-year rate of change in retail sales. Going back to 2000, consumers less confident in the economy. Well, that as they get less confident and spend less, it transmits right into retail sales. We see that again going into the great financial crisis. Consumers lose confidence, retail sales down, and now we see consumer confidence tanking to levels not seen since the great financial crisis. And what's bringing down? Well, retail sales with it. And how much and how fast the Fed raises rates will, of course, depend on how the economy performs in the months ahead. While policymakers would like to raise interest rates gradually, more aggressive action may be needed and appears to be the direction that will be taken. Of course, we heard from Powell that he intends to bring demand down. And for retail sales, that's bad news because he made it clear that demand needs to come down to the level of supply. And if you've been following the supply chain issues, well, they're in bad shape, indicating that the pain for retailers is going to get even worse. But what do consumers do when all this happens? As we've talked about, well, in the meantime, they start charging up their credit cards to deal with inflation. But when that gets out of control and wages don't grow, that picture reverses. So consumer debt soared by $52 billion in March. Revolving credit, which includes credit cards, surged by a whopping 21.4%. Despite robust wage growth over the past 12 months, average hourly earnings have gone up 5.5%. As we just discussed, consumers are seeing those gains eroded by the highest inflation in 40 years. The cost of food is up nearly 9% over last year. Gallon of gas averaging now $4.30. And paying off credit card debt is about to get even more difficult for those who don't make the minimum monthly payment. The Federal Reserve said on Wednesday and announced a half-point rate hike as part of a series of actions intended to address rampant inflation. That means interest rates will rise on everything from credit cards to car loans, pressuring household budgets even more. And all this newfound debt that Americans have is only going to get more and more expensive in the coming months, and that ultimately will lead to a recession. And one thing that shouldn't go down in a recession like retail sales does is your portfolio. Be sure to check out Portfolio Shield. I'll put a link up there in the corner and the description below. Now let's talk about what's going on in the bond market, because many people believe that this is only the beginning of what will take interest rates even higher, but perhaps they're about to come to an end and rates are about to come down and bond prices are about to reverse. Let's kick over to the Wall Street Journal and see where the story goes. It's the worst bond market since 1842. Wow, that's good news. The 4-decade-long bull market in bonds is over, but that doesn't mean you should dump them. So how much more of a beating can bond investors take? So far in 2022, with inflation raging, bonds have lost 10%, among the worst returns in U.S. history. On Wednesday, the Fed raised interest rates, the sharpest increase in 22 years. And yet, just as your body begins healing from an injury before you can feel any improvement, the worst for bond investors might already be ending. Those who dump bonds now might be making a mistake by selling low after buying high. And what do retail investors always do? They always sell low and buy high. And what we're seeing now in the market is people dumping bonds to buy equities as the Fed is draining liquidity, and now the equity market's starting to come down. And that is perhaps one of the best indicators that the bond market is near a bottom. Let's start by putting the pain in historical perspective. The U.S. bond market has positive returns before inflation in all but 4 years since 1976. Even in 1994, when the Federal Reserve raised interest rates 6 times for a total of 2.5 percentage points, bonds lost only 3% in the aggregate. As again, as we've talked about, that the Fed isn't the driver of what's going on with yields. And that's something that Jeff Snyder has talked about extensively, that the Fed does not control the long end of the curve. Even the Fed admits it in a paper they wrote long ago. But the fact is, despite popular belief the Fed does control interest rates, they really only control the front end of the curve. Inflation is a kryptonite for bonds whose interest payments are fixed and thus can't grow to keep pace with rises in the cost of living. Until recently, inflation seemed like a problem in the distant past, when it often plagued bond investors. For most of the 4 decades since 1981, interest rates have been falling and bond prices rising, creating a tailwind of capital gains for fixed income investors. Not only earned interest on your bonds, but pocketed extra profit as they went up in value. And one of the challenges we're facing here is this isn't monetary inflation. This is supply chain inflation, but investors are treating it as it's monetary based. So when the economy reverses and comes crashing down and we figure out that inflation is not due to central bank habits, well, that means rates are coming down with it. Make no mistake, investing in bonds is an act of faith that the Fed can tame inflation. So perhaps the story now about bonds is all about inflation. And that, as U.S. Treasury Secretary Janet Yellen said, will require skill and also good luck. If the Fed does rein in inflation, though, bond investors should be fine and should do better over time as they reinvest their income rather than taking it as cash. Well, shall we challenge that? Let's do it. How about here? Consumer Price Index on a year-over-year rate change. We're going to make that a constant in all of these charts. How about against the federal funds rate? Well, when the Fed raises rates here in red, inflation with a lag goes down. Fed raises rates, inflation cools off, comes down. Here we see Fed raising rates, inflation stays stagnant. Inflation rising, Fed raises rates, inflation comes down. Inflation rising, Fed raising rates, inflation comes down. You get the story, inflation getting up here, Fed raises rates, inflation coming down. So far, the early indicator is if the Fed raises rates, inflation comes down, bond prices go up. Let's continue. I got a bunch of these charts to go through. Here we can see against the monetary base, and what we can see is the Fed is going to start quantitative tightening that next month. Here's the last time they started it was in late 2017, and what happened? Inflation was high. It too rolled over and went down. How about from a balance of trade perspective? Well, when inflation goes up, we know that imports, cheap foreign imports, flood the economy. And here you can see inflation rising as imports are flooding in. And this happens with a lag. And all of a sudden, inflation comes down. And due to oil, we see it rising again. And then, of course, inflation comes right back down. Here we can see inflation rising, imports coming in, inflation goes back down. Inflation rising, imports, record level trade deficit here, suggesting that with a lag, inflation too will come down. How about from a spending perspective, average hourly earnings? Well, if they don't keep up with inflation, it can't last. And here you can see that average hourly earnings are relatively consistent. They've been growing at a slight pace, but notice inflation pops up here at around 2011, comes right down because consumers can't afford it. Inflation goes down, but consumers can't afford it, brings it back up. What is the likely direction for wages going forward? Well, it's probably down, and we've heard some data suggesting that wage growth is going to slow. That too will bring inflation down. How about the velocity of money? We talked about this on Friday. If money is not moving through the economy, well, it can't create inflation. Now, you'll notice there are times when velocity is rising and running relatively high, and that helps keep inflation up. But as velocity slows, inflation comes down. As velocity slows, you can get upward movements in inflation, but notably, it gets rejected. And here you can see velocity money slowing, and every time inflation keeps coming up, it gets rejected. This one's suggesting it too will get rejected. How about the dollar being a wrecking ball for inflation? We note that when the dollar is high, inflation tends to reverse. Here you can see the dollar rallying, keeping inflation down, and then keeping it also in check. Now the dollar is looking like it's going to break out to the upside. That too will be a negative for bond, or negative for inflation, and bullish for bonds. How about the stock market? Does it play a role here? Absolutely. As stock prices go down, consumers spend less, inflation goes down. Stocks go down, inflation goes down. Stocks start to slow down here, inflation stays relatively low. Stocks flatten out, inflation goes down. Market early stages perhaps of coming down, and that will take care of inflation as consumers spend less. And so as you can see, there's a number of indicators that perhaps at the bottom in the bond market is coming soon. Does that mean it's going to end tomorrow? Well, not necessarily. It just means that when inflation starts to come down, if that is the sole driver now of why yields are rising, well, get ready, because the Fed is going to send us into a recession. And if all of these small businesses who are missing their rent payments are any indication of what's to come, it's going to be really bad. Of course, that will be why rates are probably headed back to zero. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.